Hello and welcome to Season 3 of the Financial Secrets Revealed podcast, Meet the Experts. Today, the expert of choice is the lovely Cameron Gleeson from Betashares, who are Australia's #1 provider of ETFs, I understand. Welcome, Cameron.
Hi, Amanda. Great to be with you.
Thanks for joining us. Now, ETFs, it's a phrase that's been bandied around quite a bit and people often mix it up with EFTs. So can you tell us a little bit more? I mean, they've been around for a while now. What are they? What does it stand for? How do they work?
Yeah. So EFTs. No, ETFs, exchange traded funds. Most people are familiar with the concept of a managed fund. So a managed fund is a pooled investment vehicle where you put your investment capital together with other investors and you get a proportional share of the overall gains and losses of that fund, which are managed by usually a professional or responsible entity. The difference with an ETF from a managed fund is from a legal framework, an ETF is the same as a managed fund. It's governed by the Corps Act, the same legal regulations. The difference is for an ETF, the way that you as an individual investor might buy or sell investment in that fund is through the exchange, through the ASX. So rather than, if you remember the old days, we used to get a product disclosure statement and turn to the back and there'd be 20 pages of application form you had to complete. That's how you used to apply for a managed fund. These days, you can just use an ETF and you can buy that through your online trading account. So a much simpler way of accessing.
So it's basically buying a managed fund on the stock exchange.
That's right. I think that's the best way to describe it.
Okay, so what's the difference if I want to say go and buy an individual stock like a Commonwealth Bank share or a managed fund versus an ETF? What's the difference between all those options?
Yeah. So, I think if we think about the difference between a managed fund and an ETF, there's two elements to it. What's the underlying asset that you're buying? Now, a managed fund and an ETF can have the exact same underlying investment strategy, but the clear difference is the way you buy it through the ASX first paper form, for example. The one difference you generally see with ETFs is they tend to be passive or rules-based exposures, and we can get into that. I'm sure we will dive further into that, but that results in sort of different outcomes from an investment standpoint versus actively managed funds. We constantly talk about actively managed funds. So that's an ETF versus a managed fund. An ETF versus buying, for example, an individual share, well, the process or the method of buying an ETF is the same. You're going onto your online brokerage account, you're clicking buy when the ASX is open. But the investment itself is clearly very different. So when you're buying BHP shares, you're getting exposure to one enterprise. When you're buying an ETF, typically they are very much a diversified exposure. So it's a way to get exposure to, up to over 1,000 companies or securities in one single trade.
So if a managed fund has 50 different stocks in their portfolio and you buy that ETF that's listed on the exchange, you may well get exactly the same, those 50 stocks, when you just basically purchase that one exchange traded fund.
Yeah, that's right. It's just a simpler way of investing, if you like.
So are they a good investment compared to a managed fund or buying a share? What are the pros and cons of one over the other?
Yeah, so obviously this is general advice only. Look, you can think of it as what are the advantages and disadvantages. First, let's just talk about that relative to a managed fund to start with. Well, some of the advantages are that the ability to know when you're buying an asset, it can be quite important for people. And if you think about the investment process for buying units in a unlisted managed fund, you typically send in that application form, but you actually don't know how many units you're getting for a couple of days after that. And when you sell or redeem out of that unlisted managed fund, you don't get your redemption proceeds for some period of time further down the line. Now, that can be really important in terms of managing your cash flow and changing from one investment to another. And that's a clear advantage to buying listed products, including exchange-traded funds, where you know the price you're buying in. You can set a limit as to how much you want to pay for that asset, and you know the exact amount of cash. And as every other vehicle, a investment or a purchase or a sale on the ASX takes 2 days to settle. So the money's in your bank account 2 days later. So just from a, if you like, a process perspective, there are a lot of advantages around that. Now, I talked about the diversification benefits versus, an individual share of holding that pooled exposure to an ETF. But if we think a bit about how ETFs evolved, the first ETFs available were what we'd call broad market equity exposure ETFs, so index tracking ETFs. And I think what time has sort of really shown there is that it's very difficult to, as an active stock picker or active fund manager, to add alpha. And we often see that that active managers can end up with higher levels of volatility or risk in their portfolios than the broader market. And clearly an advantage of using an index tracking approach is that you don't have to pay the salaries and all the expense, the research that an active manager will embark on. So the cost at which a index tracking ETF is offered at, or the management fee, is often a very small fraction of what an active manager will charge. And we know that costs compound over time. So that cost advantage can be quite significant if you're looking to compound your wealth over time. So there's some of the advantages. Of course, ETFs have broadened in terms of the investment strategies, and we now see a lot of actively managed ETFs. But in terms of the way that most people think about ETFs, they think about that cost advantage, about getting broad market exposure and diversification.
So a standard active managed fund, I guess you'd be looking at around maybe 0.7 up to possibly 2.5% in fees for an active managed fund. What are the fees sort of spread for an ETF instead of a managed fund?
Yeah, so it depends on asset class and the type of investment strategy. If we take, for example, the lowest cost broad market Australian equity ETF available on the market, that's Betashares Australia 200 ETF. That's the 200 largest stocks on the ASX 200, and the fund has a management fee of 0.04%, or 4 basis points.
Wow.
So it's incredibly cheap. A really good way of getting exposure to the whole market really efficiently. We've recently launched a global fund, which is basically global equity markets except Australia or excluding Australia. So if you want your global exposure, and that one has a management fee of 0.08% or 8 basis points. So when you think about it, this is really incredibly cost-effective way of really building a portfolio that gives you access to asset classes. We tend to see that other asset classes like fixed income cost a little bit more. For example, core fixed income exposures, you might be talking about 0.1 to potentially 0.3% as a management fee. And then we've got the ETF universe in Australia is quite rich. There are around about 200 funds that you can choose from. There are various flavors, whether it's sectors, thematic funds, country exposures. Some of those tend to be a little bit higher in terms of the fee load, because obviously they don't necessarily have the same scale as those broad market exposures. But generally speaking, cheaper than active fees. And then there are also those actively managed funds, which may be charging fee levels, consistent with an unlisted managed fund. So there is a range, and I guess the good thing is you have a choice.
Yeah, absolutely. So where you can be looking 1% up, standard indexing style funds are much less than that and likely to be under 1% as well. So sound like they're good for cost. Obviously, if you're doing it on the stock exchange, I'm assuming there'd be a brokerage fee as well. So I guess that just depends on the individual brokerage house you choose, whether you're a ComSec or an E-Trade or a desktop broker, one of those, you'd have to pay your usual brokerage fee on top.
Yeah, so important to factor that in. You also need to factor in the buy-sell spread of an ETF. And if you are considering that as an option against, for example, an unlisted managed fund, in the PDS or the website of the unlisted managed fund, you should be able to find the application redemption spread there. You can go to the ASX website. Actually, they've got statistics in terms of the average buy-sell spread on ETFs. Broad market ETFs have extremely low buy-sell spreads as a general rule relative to unlisted managed funds. Some of the more niche ETFs have wider spreads, particularly if they're offering offshore equity exposure or fixed income exposure. But yeah, you want to take into account the management fee. You want to take into account that buy-sell spread, whether it's an unlisted fund or the ETF, and you want to take into account the brokerage. So they're the sorts of things that you need to be thinking about from a total cost perspective.
Cool, good tips. So who would they be appropriate for? I mean, are these the sort of things mum and dad investor can go to? Is it sophisticated people? Would self-managed supers? Who's it right for?
Yeah, so sometimes there's a bit of a misconception that, I mean, I mentioned them being sort of low cost, diversified, and the fact that anyone can access ETFs sometimes leads people to the view that, well, the really sophisticated, high end of town don't use ETFs. But actually, sort of nothing could be further from the truth. If you look at, say, for example, some of the world's largest, US hedge funds like Citadel, some of these are extremely large and active users of ETFs. So they really are used by all types of investors. There are different types of ETFs that may be more suited to a particular cohort. One that I think is a really interesting fund to consider for someone who's starting out in an investment journey is to use a diversified ETF, which the term diversified ETF, we've talked a lot about diversification. Most ETFs will provide you access to one asset class. That might be Australian equities or global equities or fixed income. A diversified ETF describes an ETF which invests in a range of asset classes. So rather than having to build a portfolio out of, say, 3 or 4 ETFs or maybe more, you can basically buy an all-in-one solution. So an example of that would be DHHF, which is our Betashares All Growth ETF, which provides diversified exposure to Australian equities and global equities from developed markets, the US, Europe, and also emerging markets. So it's a way to get your complete equity exposure with one trade on the ASX. And obviously, if you're a young investor starting out, that could be something which is quite appealing. But because there is so much choice available, obviously there are solutions that have been designed for different types of clients. And we see the full range of clients use ETFs. I talk to people all the way from private banks, family office, institutions, all the way down to mums and dads.
Perfect. So they sort of fit everywhere, from institutions right down. So interesting. You talked about sectors a few times. Can you go through what these asset allocations and sectors and the geography, you mentioned international and local, how does all that work in an ETF?
Yeah. So, some of the core ETFs that people tend to use are, for example, an Australian equity exposure, or they might use a global equity exposure, which is typically a market cap weighted exposure to the largest companies in the world, excluding Australia. So they're typical ways that people will start to think about building their portfolio.
So can you give us an example of some of these international companies that they would recognise?
Yeah. So if you're an Australian investor, it's not necessarily easy to buy shares in your likes of Microsoft, Apple, Nike, Nvidia, JP Morgan. You can essentially get access to a market capitalization weighted exposure to all those companies. Through, if I mentioned BGBL, which is a fund that does that. Now, rather than making individual investments in each of those companies, what I mean by market capitalization weighted is that your $100, which you invest in that ETF, is allocated in proportion to the size of each of those companies. So if you think about that $100 as a pie, the larger stocks would have slightly larger slices of the pie, and then the remaining $100 is divvied up in smaller and smaller parcels until you have the sort of fractional representation of basically the global equity market. So
which is a great entry way of getting in, because some of those funds, you wouldn't be able to buy a single share with $100. Some of them you need $250,000 for a single share. So yeah, pretty amazing to be able to get even a minuscule exposure to some really big players that everyone's heard of.
Yeah. So to come back to your question, so sector exposures within finance, within markets, we typically talk about the market as we'll talk about the Australian equity market, and that can be divided up into what are known as sectors, which roughly approximate various industries. So financials in the Australian equity market is a very large proportion of our overall equity market. So it's roughly about 28% of.
So that's the things like the big four banks, insurance companies, they're the sort of things in the financial sector?
That's right. That's right. Yeah, and then companies like ASX are even in that sector. The next largest sector is materials, which are resource companies like obviously like BHP, Rio, but gold miners and alike. Energy transition metals.
Newcrest,
So that,
Santos.
yeah. Yeah. So Santos sits within the energy sector because it's
Oh, there
oil
you
and
go.
gas, which is a slightly separate sector, but
Yep.
very much related. So you can start to see how the representation of the market is really broken down into different industries. And if we compare those two industries, financials and mining, to, for example, something like healthcare, which has names like CSL and ResMed, or perhaps IT that might have names like Appen and WiseTech Global, so technology companies, the way that those segments of the economy behave over time can be very different. If we're in a commodities boom, if you believe that commodity prices are going to rise, you may want to invest in a particular sector. And that's just one of the great things about ETFs is the choice and the ability to find an ETF which provides the exposure to that sector that you might be interested in. Or, we have, for example, ETFs that can provide you exposure to India, IIND, which is our Betashares India Quality ETF, or, for example, Japan or Europe. So depending on your view, you can tilt your portfolio to take advantage of where you see an opportunity, whether it be in an industry sector or in a country, or in fact, even in particular themes, so structural change. So there's a whole different, there's a whole range of ways which you can look to position your portfolio to take advantage of tailwinds that you see.
So it sounds like Australia is very heavy in a couple of particular sectors. Like if we're just looking at financials and mining, that seems to be about half of our entire stock exchange, the top 100 shares or so. So what sort of things is Australia missing out on? So if Aussies who love to invest in Aussie, we must be missing out on some really big international themes if that's most of our market. So when we look at India or Japan or America, what are some other sectors over there that we're not terribly exposed to here?
Yeah, no, it's a great point, and it is something that I think we, because Betashares is an Australian founded business, and I work on the product development committee. It's actually a bit of an advantage that we have. We're constantly thinking about how to build portfolios from the perspective of an Australian investor, because frankly we're all Australian investors, and our market it's just so skewed to cyclical sectors, so sectors that are very much tied to the economic cycle in banks and mining. That we've got to constantly be thinking about how can we bring complementary exposures or investments from offshore into Australia. So the types of sectors where excuse me, Australia is quite underweight include obviously IT, and you only have to look at the makeup of the US equity market. The largest sector there is IT. Healthcare, we have a very it's a relative. We've got about 8-9% healthcare in the Australian equity market, but dominated by just a couple of names. Our healthcare sector isn't as large, and industrials is, for example, another area. We don't seem to do too much manufacturing in Australia anymore. So there's a few sectors where we're very much underweight, and the characteristics of some of those sectors at different times in the market cycle can be very different to Australia. So by blending complementary exposures from countries, whether it be the US or in fact Asia or Europe, when we can blend those exposures together with Australia, we get two benefits. One is that their economies might be at a different part of the cycle, so you get a diversification benefit due to that. They might be raising rates when we're cutting rates in terms of our central bank policy. But that second element is, what does that sector make up, and how does that compare or complement our overweight to banks and miners in Australia?
So if I'm a bit of a nerd and I've researched some futurists, and they're like electric vehicles are the way of the future, and AI and robotics are taking over, or lithium batteries is everyone's got to jump onto lithium mines. How
Mm-hmm.
do I then go, well, I think this is the way of the future? Like I'm interested in food security, or
Mm.
growing plant based, or these days they're printing meat. So if I'm interested in that, how can I then go, well, where are the companies that are doing this? Like, how do I find that?
Yeah. So there are a range of what I call thematic ETFs, which those sorts of structural changes you talked about, that ourselves as well as other ETF providers in Australia have exposures which are designed to try and capture the companies, the equities that have tailwinds from those particular areas of structural change. I guess the first thing to do is you can obviously go into the ASX and look up, what ETFs are available, or in fact, look at an ETF provider's website. You can look, for example, under Betashares website under funds and look for thematics, and you'll see the names of those funds. But I wouldn't necessarily suggest because you see, electric vehicle ETF, you should then just go and buy that. It's very important with those types of funds to understand what you're getting exposure to. We sort of talk about looking under the hood. Have a read through the fact sheet. One of the really good things about index tracking ETFs, which is what most ETFs are in Australia, is that the ETF provider is required to show the index rules, so how companies qualify for inclusion, and then they also show the portfolio, the proportions of each stock in the portfolio, the sectors they're from, on a daily basis. So you have this full transparency, which you don't necessarily have with unlisted funds. So that transparency gives you the opportunity to do your homework and look through the fund. And if you're not sure why a particular stock is in your electric vehicle ETF that you can see, well, then call up the ETF provider or read any publications they have on that particular theme, and find out why that might be the case. It's very important to do your homework. Don't just read the name of the fund or the ticker code and buy. But these areas of change, can be quite dynamic. And I guess our approach and our thinking to thematic investing is that because in structural change there's a high degree of failure. You see a lot of companies fail, but you also see certain companies will tend to grow larger and grow market share. We call this the winner takes all sort of paradigm in structural growth. And because of that, our view is that the best way to invest in an area like that is to try to hold all companies within that structural theme rather than try and pick individual winners. So that's the philosophy we embark on when we're building a thematic ETF, is to try and hold all companies which are adequately exposed to that theme. And of course, if you had any questions on any of our funds, we're happy to talk to you about why those companies qualify.
Sure. I'm happy to put in the links to Betashares in the show notes for anyone interested. So I suppose when putting together a portfolio, if you haven't done that sort of thing before, sticking with the big things like an Australian share index or a global index, and then maybe keeping the thematics to, a smaller percentage, maybe 5% to dabble if there's something that's really of interest and you do your homework, probably isn't a bad way to start in that space. Because obviously they're very new, even though they may have a long-term theme, but yeah, they've got a long way to go, a lot of those, don't they? So, and we've seen, in the past where they come onto the market and everyone's interested, and, not long after they fall in a heap. So it has happened. So I think you've said earlier, Betashares are Australia's largest ETF provider. Do you know how many, I'm just spitballing here, providers of ETFs there are in Australia?
Amanda, I thought you made that claim, but I liked it. We might call ourselves Australia's leading ETF provider.
Leading,
so we are the second largest ETF provider by both assets under management and generally we're either number one or two in terms of flows, so net new invested money into funds. There's about sort of 5 ETF providers that have a relatively broad range of funds on the ASX. There's also a number of active managers who have launched a single fund. So there's actually a relatively long list of managers now with an ETF available in the ASX. Some of those will only have 1 or possibly 2 strategies, but there's possibly sort of 5 mainstay product providers, and we've just been very fortunate in terms of having received support of Australian investors and and that's obviously led to fortuitous outcome for us in terms of flows and the assets that we're able to look after for people.
So if someone goes, all right, this ETF thing sounds all right, I think I might give it a crack, what sort of things should you look for in a provider when you're doing your own due diligence at home? If there's like the big five to choose from, what kind of things would I want to compare when I'm pulling out the information?
Yeah, so I mean, I think it's important to, even before you start looking at an ETF, when you're building a portfolio, and I talk to clients about this a lot, the first step isn't necessarily to look for an ETF or even look for a fund. You want to decide on your overall asset class allocation. Try to form some opinion of your risk profile. If you've sought professional advice, financial advice, that might be helpful in forming a view of your risk profile, and then determining what allocation do you want to have to different asset classes. Because we know there's no free lunch in finance except for diversification. And so there can be benefits from combining, for example, equities and defensive assets like cash and bonds. So before you're even looking at an ETF, that's the first decision to make. That's the top level decision to make. Where do I want to allocate money? And then obviously you have your decision as to beyond that. Okay, this is how much money I'm going to invest in Australian equities. Now, what type of investment do I want to have? Do I want to invest in a basket of shares that I choose myself? Do I want to use an active manager or use an ETF? So they're the sorts of decisions to make first, and it's just important to highlight those. Once you come to the decision that you're looking to allocate to an ETF, some of the considerations will be the caliber of the ETF provider is obviously important because that can help with things like ensuring that the ETFs that they have trade really efficiently on market. If they are very much embedded in that ecosystem, they'll be ensuring that the buy-sell spreads that you as an investor are effectively, paying will be as tight as possible. But look at, that ETF itself. Look at its index methodology. Look at the companies it holds. Look at the cost. Look at how it's traded relative to the index that it tracks if it's a passive ETF. So on that ETF provider's website, you should be able to see a performance tab or a performance table. And if it's an index tracking ETF, it'll show the performance of the ETF and the performance of the index which is tracking. So that ETF provider will essentially be trying to buy, in almost all, there are exceptions, but in most index tracking funds, the ETF provider is buying the basket of stocks which essentially represent that index. And ideally they're able to replicate the performance of that index very closely. So there's some of the things to look for. But beyond that, you're also trying to select an exposure which is going to complement the rest of your portfolio. So we talked about this before, but if I'm in global equities and I know I've got a large allocation to Australian equities, well, do I want an ETF which is going to provide exposure to, Canadian oil and gas companies and Canadian banks, or am I better off having something which has higher weights to healthcare and IT that aren't well represented in Australia? So they're the sorts of decisions that, sorts of things you need to look at. This is general information only, of course.
Absolutely.
But
Keep saying
yeah,
that. Not investment advice, general information only, for sure. So it's a lot more complicated, I suppose, than pulling it out, seeing how it's gone for a bit and what the fees are. There's a lot more to it. And I suppose for those who've never done it before, seeking the help of a financial advisor to work out your risk profile. And I call it the sleep at night factor. You don't want to be lying there going, what have I done? If markets go down. So you really need to be able to test that beforehand and understand where you'd be comfortable.
Yeah. And I guess that's a really good point you make. I mean, it's not just about looking at past performance. The one thing I try to do, and it can be difficult depending on what tools you have, but is not just, obviously people do look at past performance, but try to focus on the past risk. Like where is the particular fund likely to do poorly? And that's sort of a framework I have myself for thinking about a fund and making sure I don't get too overly, wedded to considering how well it's done in the past. Is look at the risk rather than the past risk rather than the past return.
Good tip. Now, clients are more coming to me these days with social and ethical concerns. They want a bit more of the ESG, and we've gone into another podcast talking about this sort of, I suppose it's a new thematic in a way. How does Betashares manage? Is every single fund now measured against an ESG, or is it a particular concern? How do you guys do it?
Yeah, I guess the approach that Betashares took to providing access to ethically managed portfolios was we weren't necessarily the first to market in terms of what you might describe as an ESG portfolio, but the original ESG screened ETFs were what we might call relatively lightly screened. Um, they basically filtered out certain a relatively short list of industries, and they filtered out based on whether the company was involved directly in the industry. So was the company in the oil and gas industry? Now, they also, didn't really deviate, or the performance looked very much like a broad market capitalization weighted index. So they didn't really give you much different to what you were already getting in a diversified exposure. Betashares' approach was that we really needed to provide something which was true to label. That's where we sort of saw demand in the market. And so, we embarked on a process of building something which was more comprehensive in both its positive and negative screening, but also screening on things like, indirect revenue exposure. Not just, is this an oil and gas company, but also, is this an engineering firm whose main customers are oil and gas companies? So it's thinking about those second order implications. And to do that does require, in our case, we use our own responsible investments committee. There's a lot of actual research and analysis that goes on in terms of building out that the database, the understanding of what these companies are actually doing, and building the portfolio. We also spend a lot of time in terms of company engagement, voting in line with the principles of the ETF, or the index rules that are baked into the investment philosophy of the ETF. So our view was to really provide what we consider a dark green or true to label exposure. Now, the one really good thing about being an ETF provider is, provided you are being really dark green, I guess the DNA of an ETF provider is transparency, and so index tracking rules-based ETFs will publish all their holdings on a daily basis, and so people can actually test this, and they can say, okay, here's a Betashares ETF, which is supposed to be an ethical ETF, and here's another ETF which is supposed to be an ethical ETF. What do they both hold? They can look through and go, well, actually, I don't know why that company's in there. And they can call up the ETF provider and ask those questions. So that's a really positive thing about ETFs. And in fact, organizations that I guess are stakeholders in ethical investing really do value transparency. And it's certainly an advantage that transparency DNA of an ETF provider has. That was sort of our approach to building out that suite. Not all of our funds offer, a strict ESG mandate. We have what we describe as our responsible and ethical range of funds, and that includes core ethical funds. So, like ETI, for example, is our global sustainability leaders. FAIR is our Australian sustainability leaders. That's your global core ethical exposure, Australian core ethical exposure. We have GBND, which is our sustainable bond ETF, which is fixed income. So they're your sort of core building blocks. We also have Earth, which is, we consider it an impact fund, which is essentially investing in companies that have decarbonisation solutions. And then we have sustainability themed ETFs that don't necessarily cover all the aspects of ethical, because ethical includes both societal and governance issues. The sustainability themed funds really address issues around environmental concerns, and they might be ones like TAN, which is our solar ETF, or like XMET, which is our energy transition metals ETF, which is important for the energy transition. So we have a range of funds sort of in that suite. Not all of them are what I define as truly ethical, addressing all the ESG, but obviously people will have their own views, and they'll have particular things that they want to invest in. So that's certainly been our approach.
Yeah, it's an interesting space, isn't it? Where it started with, let's just get rid of the baddies. Then it was, well, then include the goodies. And then it's like, well, get rid of the guys who are using the baddies. It's sort of
Yeah.
become so complex over the years that it's, yeah. And then we've seen, the big scandals with, huge companies getting in trouble for greenwashing their products and not being as true to label as they should be. So nice to see some of that coming through actually for the consumers, I believe. So thank you so
Okay.
much, Cameron, for sharing all these tips and traps on ETFs. Do you have any final information for people who'd like to learn a bit more about it or take it to the next level? Something you can leave us with, going forward in the ETF space? Love to hear it.
Yeah, so look, we have, if you go to our website under Insights, you'll find some great educational information. If you're new to ETFs, you just want to understand, look, how do I trade these things? How do they work? That's available there. But whether you're looking at a Betashares ETF or any other ETF provider's ETF, look, I think if you're not sure, look, just call. Generally speaking, I find that ETF providers are very willing to help new investors, and that they invest in good client service teams, because we understand that a large part of our role really is education. I mean, I think that the advantages of ETFs as a form of investment structure, they sort of speak for themselves. So it's really incumbent on us to ensure that people are comfortable with ETFs and understand them. So don't feel like you're infringing on an ETF provider by asking them, look, how the hell do these things work? I don't quite
Perfect.
understand it. Tell me more.
Excellent. So that's a little course you can undertake yourself. I'll make sure again that link's in the show notes for anyone who wants to learn a bit more. Again, Cameron Gleeson from Betashares, thank you so much for your time. It's been great having you on the show.
Thanks, Amanda. It's great.